All right, all right. Welcome to the Big Skinny with me, Lou Basenese, coming to you live from Palm Beach Island because, I try to get away from the freezing cold in New York every now and again. If you're joining us for the first time and wondering what this Big Skinny is all about, well, it's all filling zero fluff. We try and distill down the headlines and the market movers to the things that matter. So you get nothing but pure signal, no noise. Some people have called us the sports center of financial news. I'll take that. I like the highlight reels. We have a distinct style. We bring you, first and foremost, one headline that you should probably ignore, one chart that's got key data that leads you to the investing insights. And then we give you one investing action to take every week in our rundown. Because let's be honest, folks, we can have fun together, but if we're not making money while we're having fun together, we won't be hanging out much longer. So along the way, we take your questions. We're live streaming on multiple platforms, X, as well as YouTube. So please, there we go. Los Angeles in the house. Can't wait for natural gas to surge more so my prop goes up. Yep, prop has some exposure to natural gas. We've got more exposure to oil. We can cover that and more later on in this episode. But folks, this is a choose your own adventure show. So please do not hesitate to join the conversation and change the direction of where you go. All along the way, we're going to explain things in an easy to understand format that hopefully beginners can appreciate as well as the experts can appreciate too. So folks, with that being said, we're going to get right to this week's topics. As coming first at you, we got one main guest. She's known for her bold predictions and even better performance. I'm talking about Beth Kindig, the lead analyst and founder of the IO Fund. You've probably seen her on CNBC, Fox Business, Charles Payne's show, Bloomberg, all over the place. And she's going to share with us her bold prediction for why Nvidia could go to a $20 trillion market cap. After that, we're going to go back to our top 10 AI stocks not named Nvidia and provide the second half of our update on the top 5 performing individual stocks that we recommended all the way back in June that are up an average of 54%, I think, based on the latest number crunching. And last but not least, we're bringing in the Dodman for headlines and head scratchers, where we review some compelling charts and some head scratching headlines and give you the skinny on what you should pay attention to and what you should just flat out ignore. And a week like this is a week leading up to the Fed's next decision to cut rates. So folks, let's get to it with this week's rundown. I'm coming out throwing punches right like Rocky Balboa this week with a headline straight out of the information that is, I got to tell you, it's probably the most self-congratulating, idiotic headline I've ever seen, saying that, Nvidia's stock falls following the information's report on Google Meta chip talks. So if you recall last week, the big hullabaloo was about Google getting in bed with Meta to sell it custom AI chips when Meta has been a longtime customer of Nvidia. And here the information saying, tooting their own horns, that the stock fell first on their original report. And hey, let's rerun the same news and say the stock fell again because we're awesome for creating fear, uncertainty, and doubt in the markets. And folks, I'm here to tell you this headline is nothing but that: fear, uncertainty, and doubt. And why is that? Well, let's see. We've got a lot of people out there falsely believing that it's Nvidia or Google, hence the name of our episode today, Google versus Nvidia. But you got on one side the likes of Dan Ives, a very well-known, super successful, just the guy that is the tech analyst that everyone knows, saying that Nvidia is the Rocky Balboa champion of the AI revolution. But what about this new deal with Google and Alphabet? Well, you've got none other than Gene Munster, who, I got to tell you, folks, at the beginning of the year was known for his bearish comments about Alphabet. Now, yours truly was actually very bullish, but now Gene Munster's coming out and saying, hey, look, Alphabet's the best Mag 7 stock to own for the next year. He updated his comments today and said Apple's the best for the next 6 months, but Alphabet for the next year. So which is it? Should we be buying Nvidia? Should we be buying Alphabet? Well, let's think about some of the commentary out there. None other than Dan Newman, a fan of the show. Newman, he's saying, look, this is not a zero-sum game. And I completely agree. It's not buy chips from Nvidia or buy chips from Alphabet. It's buy chips from Nvidia and Alphabet, and he knows it better than any other. Dan is embedded with some of the top tech companies, seeing firsthand on the front lines how strong that demand is. And I concur. We got 3 to 5, maybe 7 years before this demand surge really plateaus out and causes any potential problems of choosing between it. And here's why, right? Data center construction spending, we showed this last week, is up and to the right, high and far. It's about $40 billion annually right now. This number keeps going up pretty much every week. So that shows you that there's going to be plenty of chip buying to fill in these data centers, right? Well, what are we talking about in terms of actual dollar value of chips? And that's, well, let's see, the total spending. Actually, let's put it in perspective. This is one thing I wanted to point out. Big oil majors have always long been understood as the biggest spenders on Wall Street, but not anymore. Big tech is spending way more and getting way better returns on their invested capital here, as you can see in this chart. The likes of Alphabet, Microsoft, Meta, Amazon, and Oracle are in danger zone. They're spending a little bit too aggressively, taking on too much debt. But folks, this puts in perspective how big this boom's going to be. We're still in the earliest innings. Now let's put this debate of Google versus Nvidia to bed once and for all with our money chart for the week, showing you exactly what I said and what Dan Newman said, is that it's not either or. You're going to sell GPUs, what Nvidia sells, the general processing units, and you're going to sell these custom chips as well. It's additive, not subtractive. It's not either or. And you can see this full speed ahead growth through 2028 based upon all the estimates out there. Now, I will go out on a not too far limb and predict that these growth estimates are going to be raised higher and higher as we get further into this boom, which brings us to the investment insight of this week, what you should be doing with your individual portfolio. Same thing we've been saying all along. Buy Alphabet, as I have been saying since January of, beginning of this year, January 27th. Also buy Nvidia. Now, full disclosure, I've been late to the Nvidia game, but I believe in the last year, I've come around to the fact that they are the undisputed champion, as Dan Ives said. So they're going to continue to lead this market higher. But Alphabet is showing everyone, too, that AI is not going to kill its business. It's not going to kill its search business. Its monopoly in that world is only going to help it build a better AI chip business. So, folks, that's the takeaway. If you don't own any Alphabet or any Nvidia, you should. You should find a way to put it in your portfolio before it's too late. Now, before we get to our first break and our first guest, I want to remind you to follow us on socials. Don't forget to chime in as well while you're there. We're trying to get a smidgen, a little bit closer to Mr. Beast's following on YouTube. So please subscribe to us on our YouTube channel, where that way you'll make sure you get all the updates for additional interviews that we do, additional content, but most importantly, a reminder before we go live every week, Mondays at 5 p.m. With that being said, we're going to get right back with our first guest, who is going to bring to us the investment case for why Nvidia, of all names, can get to a $20 trillion market cap. That's about 5x from where it's at right now, folks. So stay tuned. We're coming right back with Beth Kindig.
Now, next pick, Google. What are you
right into the storm here, right? Taylor brought it up. There's some regulatory pressures, maybe monopolistic tendencies that they might need to break up. Totally overblown. This is the cheapest stock in the Mag 7, trading at about 22 times forward earnings. You look at an Nvidia before today, it was at 33, 34 times. So I think if you're going to go buying on a dip in the Mag 7, this is the company you want to play. Not going to get broken up, and they will figure out how to stay competitive. As Taylor also pointed out, Gemini neck and neck with DeepSeek on these early versions. So,
Taylor, thanks for joining us.
My pleasure.
Brave guy, Lou. Brave guy. Thanks, everybody.
All righty, welcome back to the Big Skinny with me. It's the time of the show where we live out our just core principle here to be humble or be humbled in the markets, because we know we don't know everything. And I am extremely honored to have a guest with us today who has one of the best track records in tech. I'll argue, I'll stack it up against anyone. And she's also made some of the biggest predictions, not just in big tech, but also with big Bitcoin, which we're going to get into in a moment as well. So without further ado, I'd love to welcome Beth Kindig to the Big Skinny.
Hey, Lou. How you doing?
Hey,
Thank
Beth.
you for having me.
Good to have you here. I see you everywhere now, Bloomberg, CNBC, Charles Payne show. And I'm just going to jump right in. I mean, you put the bold prediction out there, Nvidia to a $20 trillion market cap. Help us understand how you get to that and why you think it's reasonable and what's the time frame?
Sure. 20 trillion market cap by the end of the decade. We were revisiting our 10 trillion market cap original prediction. And I said, wait a minute here. This thing's going way higher by the end of the decade. Felt like I needed to go ahead and let my readers know that. There are a couple of assumptions with this prediction, as there is with every prediction. The first is that NVIDIA has about a 20 to 25 forward sales valuation. It would need to maintain that sales valuation. It's maintained that since 2020. That's a reasonable assumption. Secondly, they would need to grow 3x by the end of 2026 to 2030. I have 4 years for NVIDIA to grow 300%. Now, keep in mind that they've grown their data center revenue. I'm talking about here. They've grown their data center revenue 500% from Hopper to Blackwell Rubin, which is about a 2 to 3 year time frame. So all around, this is pretty conservative, actually,
Yeah.
considering the stock that I've been following for many years.
Yeah, when you break it down, that headline doesn't seem so aggressive when you get into the weeds on it. And I'd argue,
Mhm.
gosh, I hate to say it, it could go even higher than that because a 25 times forward earnings multiple, NVIDIA traded as high as 30, 35 times before. So it's not impossible for it to go even higher than there. Let me ask you this. What are the risks that you see? Let's talk about the Google. Other companies are going to start buying from Google instead of NVIDIA. How do you calculate or factor that into your model?
Okay, when it comes to TPUs, I want to say they've been out for a decade already. Okay. And in terms of application specific hardware ASICs, that's a different use case than the general purpose GPUs that NVIDIA puts out. That can work on any
Right.
workload, any framework, any architecture. That's very different than training something very specific to what your business does, which is what TPUs, what Google's been doing for 10 years. Now the rumor is they may outsource that to a company like Meta. That's not a big risk to NVIDIA, as big as the market thinks, because there will always be overwhelming demand for those more general purpose GPUs.
Right. So, I mean, I've used the analogy, and correct me if you think it's wrong or if you have a better one, is the GPUs are like the Swiss Army knives of AI chips, where these TPUs or custom chips are more like your paring knife or a specialty knife where you're never going to use them as much, but therefore they're good to have in the kitchen for you. I mean, is that fair?
That's a great analogy. It's something like a maybe a screwdriver where you use it everywhere, but this is more of a specialized wrench, or you would only use it for one job only, versus a tool you would use in many different situations, companies, frameworks, applications, things of that nature. And also keep in mind that CUDA software moat. This is actually why I called NVIDIA an AI stock 7 years ago. It was the reason I said it could be the world's most valuable company at a 100 billion market cap. It was based on the CUDA software moat, which TPUs will not breach that moat. And that moat allows software developers to program GPUs. It's an extensive library that not only Google won't catch up to anytime soon, but nor will any other company.
Yeah, I mean, it's the CUDA moat is similar to Apple's ecosystem. Once you're in it, it's really hard to get outside of it. Talk to me about, I've heard a lot of analysts now saying, well, Alphabet's got a unique advantage because they have the whole stack. They're vertically integrated, right? So they earn some of the margin that some companies would have to give away to NVIDIA. How do you just refute that statement or along those lines that Alphabet has some inherent advantage if they're training and selling the chips on their own?
I think this is what I think will play out. And Lou, we can talk about this again in a couple of years. This is what will happen over the next 2 to 3 years. Google will optimize certain workloads with TPUs as they have been. They'll be able to save some costs, lower their margins on those workloads. However, they will continue to use NVIDIA for some of those more general workloads to really stay ahead on rack scale architectures. Um, Rack scale architectures that NVIDIA is putting out, I want to call this, to keep it simple, the product roadmap, the product cadence. Every 12 to 18 months, they're growing their rack scale systems at such a rate that something like Google cannot keep up with. From 8 GPUs to 72 GPUs to 144 GPUs to 576 GPUs over the next couple of years, that will be very hard for Google to compete with. Google's goal is to take certain workloads, lower those margins, but to keep building and training and running inference and some of those harder workloads on NVIDIA's GPUs.
Yeah, that makes sense. I've got a question for you because I've asked this to a few other people. In terms of the availability of compute power, right? Where the gate limiting factor is really electricity, right? We need the electricity to power these data centers. Let's say that wasn't an issue and more data centers could come online. Do you see this as something where we'll keep finding new uses for compute power, or do we ever hit a peak where we don't need any more high power compute?
Where I like to encourage people to consider how early we are is we've been in this training phase, which is compute intensive and very expensive, and it's not really the optimal monetization stage. It really inferences. Inference is the optimal monetization stage. So to answer your question, uh, we will see, in my opinion, a more sustained growth period that the market can understand once we
Yeah.
start to monetize. And that
Yeah.
monetization piece is coming. OpenAI is a really good example of that monetization piece based on inference.
Yeah, no, I agree. I think, looking at the difference between the baseline subscription and the premium pro subscriptions, the capabilities are so much better. And then once you're in that ecosystem, they're just going to be able to charge more. Question for you along the lines of, are there any other AI names or AI adjacent names that you really like in this market or that really worry you in this market? I mean, to throw out a name like Oracle, are you scared about Oracle's overspending, debt-based spending? Any ideas in that thread?
Yeah, Lou, I do participate in hypergrowth stocks, and Oracle has this hypergrowth piece with its remaining performance obligation. I mean, it's giving key metrics that are explosive. However, we are more of a cautious firm around debt, cash. We will participate, but we will use technicals for risk management. We do not close our eyes blindly and just throw money at
Yeah.
the wall. So Oracle is in one of those gray areas for me. It's not a all systems go like some of the other AI stocks, but it's certainly very interesting in terms of its backlog RPO. And we would just hold a stop on that kind of a position in case the debt continues to exceed, any reasonable amount of cash and et cetera.
Yeah, were you involved before that? I mean, you see on the chart here that huge re-rate that we all remember. It's now pulled back below that. Is this a position you actively own, or is this one that you're looking to re-enter? I mean, how do you think about Oracle at these levels?
Yeah, we tried at Oracle and I believe it hit a stop, and we will just try lower kind of thing. We've been
Yeah,
eyeing it because I think it's around that $200 mark. It has come up lately in our conversations because again, it does have really strong potential. And we're one of those types. We'll hit our stop and we'll just try to buy lower. We believe strongly in risk management when you approach a trend like AI.
yeah. So let's talk about entry points maybe on Bitcoin. I know you're out with a piece. You were very pressing on Bitcoin's pullback when everyone said it was going nowhere but up. What are you seeing now in the Bitcoin market? What would interest you to become a buyer?
We own Bitcoin. I do want to make that clear. We've just risk managed it, so we cut it in half or even 80% of the position, something like that.
Oh, wow.
Our our message overall is try to use a data-driven approach with all sentiment-driven assets, whether that's crypto or these hypergrowth stocks or something like Oracle, where the AI boom is pushing that stock higher, but there are some debt issues underneath it. Uh, Ultimately, we really like to champion that piece, which is use a data-driven approach. And according to us, according to our research and our technicals, it was a good time to take some gains. When it was above 100, 120, something like that,
Yeah. So
and try
talk
to
to me about
reload
your
lower.
Yeah, talk to me about your approach a little bit because I love the
Mm.
marriage of the sentiment-based, early stage, hyper-growth, innovative, but being data-driven. It's led you to some incredible performance. We're going to bring up a slide here that shows that you should be in the Hall of Fame with some of the best hedge fund managers here. So get into the strategy. Really, how do you come about? What's the core principles that guide your investment philosophy?
Active management, I guess, would be the best way to describe our style. What that means is we will take our racehorses, these big winners, and we will let them run, and we will continually hold stops on them. And if they hit a stop, we will simply buy lower. And by doing that, more times than not, you come out ahead compared to a long-term buy and hold strategy.
Yeah. So
When
are
you
you
look at
running
tech,
on your
yeah,
stops? Sorry to interrupt you, but are you running like
yeah.
5 to 7% stops, 10 to 12? How tight are your stops that are allowing you to get out quickly and then rebuy later on?
Our stops are different for every single stock. And I mean, we're big on everyone should have their own form of risk management. We're not financial advisors. People have to
Right.
kind of come up with that on their own. We do, of course, every trade we put out in real time. So if we've hit a stop, people know we've exited. That piece in terms of just having some confidence that you could potentially buy lower, all is well if you can. Most people, what happens is they freeze up, right? They see their
Right.
stocks down 10, 20%, they freeze and they start to grab on even tighter. We are more of the type to let go. And that's our philosophy, is to really not hold on tight to losing positions, especially in tech. Now, if you have a value investor on, or, another sector, that can work. It doesn't work in tech. And I feel pretty confident in
Yeah.
that.
A mentor of mine always told me, don't fall in love with your stocks, fall in love with your sweethearts. Because if you fall in love with your stocks, you hold on to them for too long and they turn into bigger losses. Tell us, Beth, how people can get your research in real time, can invest alongside you. What's the best way to do that?
Yeah, we put out a free newsletter every week. It's really good information. If I'm biased, but boy, do we put a lot of energy into that and time. Then secondly, we're holding a Black Friday deal right now. One of our biggest sales of the year, $250 off our advanced tier, real-time trade alerts, weekly webinars, deep dives on many AI stocks you may not have heard of. We have Credo, who reported tonight, up 15% after hours. That's a leading position on our site. We are in the trenches, on the front lines when it comes to AI, in a way that I would say very few firms are.
Yeah. Listen, I appreciate you making time to share your insights with us, especially on a night when one of your positions is reporting. We'd love to have you back when Nvidia's maybe at 10 trillion and you update your estimates to maybe 25 trillion market cap.
Yeah. You got it, Lou. Thank you.
Thanks again, Beth, for joining us. All right, folks, there you have it. You saw her performance, you understood her philosophy. And as she said, when you break down the headline of a $20 trillion market cap, it doesn't sound that crazy. It's actually pretty conservative. All you need is Nvidia to trade at about a 25 times earnings multiple, which it's done historically, and double over the next 3 years, which again, it's more than done. So to reiterate what we said at the top of the show, it's a Google and Nvidia purchase. Make sure you've got a position in your portfolio, do your research in advance, and also do me a favor and head on over to X so that you can make sure you get the latest updates in between episodes of The Big Skinny, because that's where I share my insights. Don't have an active premium webinar outside of this. So this is how you find us. Elon Musk says you should follow me if you followed me. But in all seriousness, we've got 10 top AI stocks not named Nvidia. Beth shared another one, Credo, that we're going to go through next after this short break. So we'll be right back after a quick message.
Lou Basenese is with me this morning. All right, what do you make of the inflation news? I'm saying it's benign.
I agree with you. It's benign. It's really easy for the Fed to control an inflation flare-up versus a labor cool-down. So I think this is just more of the same direction. Fed's going to cut rates. Wildly, you pointed it out, over an 80% chance of a Fed cut. A week ago, it was a 50% chance that they would hold firm. So investors are acting a little bipolar about it. But the trend is our friend here. Rates are going lower.
Yeah, okay, got it. Meta reportedly is going to spend literally billions of dollars on Google's AI chips. That will be competition for Nvidia, and Nvidia is down this morning. My question, Lou, is why is Meta going with Google's chips?
So it's Google and Nvidia. They've already secured over $100 billion worth of chips from Nvidia. They need more chips, and here's the key difference. Nvidia sells generic AI chips. Think of them as Swiss Army knives. Google's chips are more customized for data centers and AI workloads. So Meta is simply making sure that they have enough supply of chips to do all the tasks that they need. It's not an either or. It's not a zero-sum game. It's both companies. So this reaction with Nvidia, I think, is completely overdone and unwarranted.
Welcome back to The Big Skinny with me, Lou Basenese, or as these guys were joking on the break, Tim Tebow 6 foot, as I've been called before. I'll take it, though. It is this time of the show where we're going to go through our top 10 AI stocks not named Nvidia, and I've got to bring in my good friend and fellow compatriot, the Dodman, to go through this list with us. How's it going, brother?
Good, man. I think you're growing a little still. I know you're Tim Tebow, but you look a little taller, at least in Palm Beach. So maybe the sand beneath your feet is lifting you up a little.
Listen, man, my theme song is I wish I was a little bit taller. And, for my birthday, I got those Tom Cruise lifts to go in my shoes. So all is well. I'm very thankful for that. But hey, I'm also thankful for these AI stocks, man. They've been kicking butt outside the two that we canned last week. One
Yep.
was down a little, one was down a lot. But look, what's your take on this? Because you're invested in some of these as well.
No, I think, definitely after the kind of pullback that we had, they're, bouncing back. And I definitely love that we switched out, for Iris and Iron and Terrawolf, for sure. But, up, 56%. I forget what last week, I think we're at 30, right? So
Yeah,
that's,
34%, I think,
34
was
maybe.
last week. Yeah. So,
Yeah. So I definitely,
well, and
it turned right around.
yeah, last week we went through the bottom five performers:
Hmm.
Samsara, Iren, which we recently added, Innodata, TerraWolf, which is a replacement for Core Scientific, and Oddity we kicked out. But now this week, let's go through the top five performers in reverse order to make sure everyone understands why these are actually AI stocks or how they're related to AI.
All
So
right.
starting out that list would be good old exozymes, right? This is probably the least obvious AI play in the market right now. Most people don't even know it exists. It's a company that went public a year ago, and they're using AI to change the way we do chemistry, basically to discover new pathways to create chemicals. As Michael Heltzen said in his exclusive interview with us, there's a new form of chemistry. I mean, just in the pharmaceutical space alone, they can make new generations of drugs that were unthinkable before. What does that mean? Well, let's take the cannabinoid space, right? So the marijuana plant has over 140 different cannabinoids, or think of them like antioxidants that if harvested the plant, the marijuana plant, you could get small trace amounts of it, but you could never get enough out of that plant or harvest enough to be, where you could use it as a drug. Well, along comes exozymes who can synthetically create that same chemical, but do it at scale and in mass quantities, and it can have tremendous impacts in terms of pharmaceutical value. So you see the stock here having a nice rebound recently, up from about the $10 range, so up about 50% since the middle of summer. Good move. Exozymes. You've met Michael and Lassa on various conference calls. What's your take on the
Uh,
duo there?
I just love this as far as, if they keep showing, that they can outperform some of the alternatives, this becomes a pick and shovel play because it's just so wide reaching of, what they can do and create. It's, I don't want to say it's endless, but it kind of seems endless, so.
No, you're absolutely right. I mean, it's a platform of platforms. I mean, the first thing they're looking to commercialize, one is cannabinoids. I think they put that out there, but the other one is NCT. It's a molecule that is shown. It's a nutraceutical, right? So you can get it over the counter. You just haven't been able to produce it in mass quantities and at scale and high purities. But NCT has the same qualities as these GLP-1 drugs. So you're
Yeah.
seeing it satiates your appetite. It leads to increased fat burning. So imagine going to all the tens of billions of dollars worth of sales for GLP-1s like Ozempic, Wegovy, Zepbound, and instead of taking those shots, saying, here's a
Put them in a
pill.
pill.
Put them in a pill. Everyone
Yeah.
would rather take a pill than take a shot in the belly once a week. So that's the upside there with exozymes. We encourage you to check out the interview we did with the CEO, Michael Heltzen, not long ago. You can find it at tbsupside.com. And it's a well worth spending about 25 minutes to get the information and get into the details there. And we'll be talking more about exozymes and having them on the show as they announce big news.
Sounds great.
All right, next
All right.
up on the list is none other than
Astera Labs.
Astera Labs. This is a chip maker, right? They sell chips, but they also sell software and connectivity platforms. The way I think about this is if we're going to have all these data centers full of chips that need to work and communicate and be coordinated, the efforts, you need all the plumbing and the electrical and all those systems that allow those chips to communicate. And that's effectively how to think about Astera Labs. It makes the components that help run the data centers and the AI-based chips. And here you look at worldwide semiconductor sales. I mean, we were talking about just the specialized AI chips earlier being, $200-300 billion market. We're now talking about the total market for semiconductors being 800 billion a year before too long. I think this year's estimates are for 720 billion. So booming growth market. Astera Labs, another recent IPO, came to market in the last year and a half or so. Sideways type of performance here the last 3 to 4 months, but this has big runner potential in it. I mean, you saw the high there as much as $250 a share. At one point, I think this is up 150% from our entry.
They're like the air traffic control, if you will, right? You know, plumbing, air traffic controllers. They make everything just move faster and talk to each other.
Yeah, no, great way to put it, man. Look, you
Trying
gotta
to
be
work on the
lead
analogies, Lou. You do it so well. I'm trying to keep up with you, brother.
Hey, we're slapping a new label on you, man. You're no longer the intern. You're the lead analyst. Keep it rolling. Let the good times roll, my friend.
Slow your roll.
All right. Next on the list, one of the very strong performers for us as well is going to be related to chips as well. Actually, no, I'm not. I've jumped ahead of myself.
Therapeutics. No chips here. No chips.
No chips. This is biotech. And again, not many people look for AI plays in biotech. I mean, I can think of 5 or 6 offhand. So, you know, Exozymes is technically a biotech. Lantern Pharma, LTRN, is another AI-based biotech. But Gain Therapeutics is a biotech that is on the bleeding edge here of generating potentially billions in revenue from a single drug that could treat Parkinson's. So again, full disclosure, it's early. We did an interview with CEO Gene Mack as well, where he discloses that they had really compelling phase 1 data, and they're getting ready to provide some updates in terms of the biomarkers that would give an indication. In layman's terms, what the heck does this mean, Lou? These biomarkers give an indication of how it's helping the patients, right? So there's a potential based upon what we saw in animals that might be seen in humans, where it's not just stopping the progress of Parkinson's, it's actually reversing it and restoring functions. You know, so we think about Parkinson's patients, right? I mean, the most notable is who comes to mind when I think when I
Michael
say
J.
Parkinson's?
Fox, of course.
Yeah. In the interview, and Gene talked about this because they were at a conference that was all the companies that were, you know, Michael J. Fox Foundation gave money to Gain in their trial. But Michael J. Fox made an appeal, basically like, hey, man, it's been 20 years. Where are the treatments? So Gain is on the leading edge of getting something, hopefully, to market that actually can have an impact on this disease that's plagued Michael J. Fox for too long to remember. See the stocks on the move too. I think when we originally talked with the company, it was about $1.50 a share when we first had Gene on the show in the early episodes. When we did the most recent interview with him, it was about $1.96, and here we are today, closing at $3.24. So a lot of movement that can happen here. Again, as you can imagine, there's about $100 million market cap company using AI to discover these new drug molecules potential for treating heart diseases. You know, if this is worth $1 billion, this is a stock that could go up 5 to 10x from here on good data.
Are there any upcoming trial milestones coming up soon?
Yeah, they've publicly stated before the end of the year they'll provide data on those biomarkers. So again, think about this trial is difficult, is that they have to do spinal taps to pull out the fluid in the spinal cord to really assess what's going on in the body. So these patients are willing to do that. Some of them actually, a large majority of them have stayed on the trial after it ended and continue to go through that because they're seeing the impacts in their daily life. So before the end of the year, we should get an update from them. And obviously when it happens, we'll let everyone know because that's what we do here. When we put a company out there and they have big news, good, bad, or indifferent, we're going to share it with you.
All right. Who's up next? Teradyne.
Now it's Teradyne. So now we can go back to the semiconductor plays. We did 2 biotechs. Let's go back to another semiconductor. I like to think you said air traffic control for Astera Labs. I'm going to roll with the analogy that this is really quality control.
Quality control.
That's
what I was going to say.
Before, but no, if we think in the restaurant world, right? The line cooks are making everything, and that head chef Gordon Ramsay's sitting there at the pass saying that's not up to snuff for my restaurant, or that's good to go. Great job. Well, that's essentially what Teradyne does. They make test and measurement equipment for semiconductors to make sure they do exactly what they said they were going to do before you just send them out into the world and they fail. So as you can imagine, the entire semiconductor market is a potential customer. So think about all the new chips that are being designed year in, year out, and then them having to be tested and validated before they go to market. The other thing I love here, remember we had that episode with Chris Camillo talking about robotics and Most of the companies are private still. The only public one is really Tesla, and they derive $0 from robotics.
Mm-hmm.
Teradyne does 16% of their sales from robotics-based chips shipments. So
Wow.
it's an AI play.
Diversification. Yeah.
Yep, it's an AI play, and it's also a robotics play.
Awesome. Now is Teradyne, do they have one, like, one big competitor, so there's not many competitors in that space? Is that true, or is that?
Yeah, there's a few different competitors out there. There's one that I've invested in before, and I cannot pronounce the name. Its ticker symbol begins with a K, KLIC,
Mhm.
Kulik and Sofa Industries, which, if you look at it on a market cap base, is about 2.5 billion. So that's really a small cap way to play the test and measurement type market. Teradyne's almost a $30 billion market cap. So I like to go with the pure play, the big, the monopoly essentially in the space, because they're going to get the lion's share of all the growth.
Gotcha. And what about the
Yeah.
robotics segment? How big do you think that can get?
I mean, I think robotics, as it actually scales, could get the 20 to 25% of revenue. I don't think it's
Mhm.
ever going to be, but that's the next big growth trend, right? Like, you go
Yeah.
smartphones, AI, electric vehicles. I think robotics is probably the next big one as AI builds itself out. Because think about it, for robotics, I don't think people talk about this a lot, is you have to have the AI capabilities embedded in a robot that is disconnected from a mainframe, right? Like a data center, a main brain. So you got to be able to do all that compute and inference that, adjusting based upon learned models cheaply, effectively, and use very efficiently, right? Without using too much power. So
Mhm.
I think there's going to be a lot of innovation and business there for Teradyne to perfect those chips that allow you to do all those things simultaneously, essentially on the fringe of AI, right? Because that's going to be that's the bleeding edge right now.
All right. And then
I think that
speaking
rounds
of,
out the list, right?
well, you got Symbotic.
Oh yeah, that's right. The one that's up
That's
150%. And it's
yeah, the
funny.
biggest one
No,
on there.
no,
And
it's funny
speaking,
because early days, I think I mentioned it on Varney and Company right before we shared it on the Big Skinny.
yeah.
And someone gave me a hard time. They're like, there's no way, they're never going to convert on their backlog. And, lo and behold, this company has now gone absolutely parabolic. I think when we first started talking about it, it was $19 a share. I mean, if we pull up the chart here, you see it recently hit a high north of $80. To think about Symbotic, you're showing it on the screen here. These are robots that can unpack pallets from semis, that can go unpack or find a case that's in an Amazon warehouse, or a Walmart distribution center. These robots travel at 20 miles an hour or more. They self-charge as they're going across the floor. Bottom line, even like Usain Bolt on cocaine couldn't keep up with these guys, how fast they're going. And they're robots, and like, just get over it. Humans just doing these jobs are absolutely getting replaced. The good thing about Symbotic too is they have all the patents to really drive the new innovations here. It's not just about the robots, it's also the software, the systems, all that integrated into one cohesive platform that allows them to run to these distribution centers really effectively. Yeah, $85 a share from 19. I'll take it.
And,
Should have bought more.
and one of their largest customers is Walmart, right? And then
So
also
Walmart,
medical companies and things like that.
yeah, so Albertsons grocery stores are another big customer. They just got into the medical space, as you can imagine. If you think about all the hospitals in the world that use similar supplies, those distribution centers are going to be a very similar puzzle and logistical nightmare to handle. So, look, this is a company that's right, my favorite robotics play, but it's commercial robots. It's not humanoid robots. So, a lot of times you see a new technology take off in the commercial or enterprise space before it gets into the consumer space. I think, smartphones were the exception to that. They took off with consumers before anything else. But by and large, there's much more patience and cash available to
Mhm.
develop out these technologies in the business sector before it gets into the consumer sector.
Yeah. Like
So
you
that
said,
being
buy
said,
more.
I mean, maybe there's any more questions. Don't forget to ask to join the conversation live. We went through 10 stocks very quickly in the last 2 weeks. But if you got other questions, whether you're watching it back, great guest, Lou. Chad, my man, always with us. Does Beth believe CoreWeave tags along for the ride? I'm not sure where Beth falls on CoreWeave. I know where I fall on it. I think CoreWeave has really been the weakest play in the AI growth trend, the data center trend, and I see them as a reseller, right? Like, I don't know that they were doing anything unique, except that they realized that there was a fragmented market that they could roll up data center with guaranteed power. So that was the whole basis of their trying to acquire Core Scientific, not once but twice. They made 2 offers for them over the years because Core had the guaranteed power. That's just the way to think about it. Was just they were the reseller. So they also had a really debt-ridden balance sheet, and still do to this day, much more leverage than you'd want and not as much margin. So I don't know where Beth falls. That's a good question for her. If you join, and maybe we can go through some of her research, but I know where I fall. It's not a fan. I'm not a fan of CoreWeave at all. Join the conversation though. If you disagree, if you love CoreWeave, there's got to be someone out there. Tell us why, and we can debate it. Maybe bring on another guest that's a bull, but I have not met many CoreWeave bulls. So with that being said, my friend, we're going to take a quick break and come back with the favorite headlines and head scratchers to go through a few things in the markets that are causing some head scratching.
Sounds good.
Can you talk about wages growing faster as a substitute for that? Or does that not resonate? That's a harder thing to understand, like real wages. But truthfully, I think that's the only thing you can do, because if you want to bring prices down generally, it probably means that you're going to have job loss and recession, and that's maybe worse than the situation.
Yeah, so I think you put your finger on the right thing. You should be talking about wage growth, except we don't have much wage growth. So you have to focus on the fact that prices are going down until the economy picks up. I would say the positive data point here is S&P 500 companies, record margins, 13.1% profit margin means there's plenty of money to pay higher wages. We just haven't seen it yet. So.
And can I address the second part of that, which is that you have to address the elephant in the room. When a socialist is winning election for New York City mayor because he's addressing it with crazy ideas on how to fix it, if you sit back and gaslight like the Biden administration did, it's just not a good look. So
All right, it's time for headlines and head scratchers, where we go back and look at top stories that we warned you about or told you about, advised you about, to make sure we got it right, and also just to bring up some headlines that just don't make any sense whatsoever. And we don't want you falling into the trap of paying attention to something that's just noise and not a signal in this market that you should follow.
I notice we still have our birthday hats on in that image. You know,
I
I think we're still celebrating your birthday from a few weeks ago.
Every day is my birthday, man. Come on, we got to celebrate it. Yeah. The funny thing is, there we are. Look at that. I am the least celebrating birthday kind of guy for myself. I am happy to celebrate others. So the fact that we're extending this for the whole month of November is a little bit awkward. But maybe next week we'll take off.
And now we're into December, so we're gonna celebrate it this month too, I think.
Yeah, Santa Claus hats. That's what we need next, my friend. All right, what's topping the list?
A bubble babble. What do we got here?
I mean, I swear, if there's one question I've been asked more times,
we're in a bubble.
Are we in an AI bubble? Are we in an AI bubble? And I watch it get asked by every other guest on TV too, right? And radio and in newsletters and whatever, all over the media. And here's the most compelling: no, we're not in a bubble, data-driven insight that I've seen. So this takes the valuation of the dot-com days versus the current days. And as you've wisely pointed out here, the TMT stands for telecom, media, and tech, right? I want you to focus. This list is organized based upon the highest weightings in the S&P 500. So back in the dot-com days, Microsoft, Cisco, and Intel had the highest weightings. Look at those next 12 months. So forward PE ratios, right? 69, 101, and 32. You add that up, and that's like a 61 times average forward PE multiple. Go back to where we're at now. Nvidia, Microsoft, Apple, you're basically at a 31 times forward multiple. So we're half the valuation level we were in the dot-com days. That's not a bubble, but everyone wants to say this is the dot-com 2.0. It's not. We're not there yet. I'm not denying that things are inflating. I'm just telling you this balloon's nowhere close to bursting. It's not, just on valuations. If we look at actual margins, if we look at actual earnings from product sales, like none of it is like the dot-com days.
Another small thing I noticed on this, and it was the fact that Microsoft is the only one on that list that's still on that list from back then.
Isn't that wild?
It's wild just that the amount of companies that have just exploded in the last, not so many years that, these are not the largest anymore. Just crazy.
Yeah, I mean, you'd think Intel, a name like Intel would still be on there. You'd think maybe an Oracle, but no such luck. Not big enough to make the cut here. But great observation on that as well. I think, this is why I think underpins our investment strategy is you don't have to be first to the tech trends, right? You just have to recognize the big trends and make sure you then invest when you recognize it. Because if you bought Nvidia a year ago, or 6 months ago, or 2 years ago, you're up. Either way, you're up, right? And yes, you may have made more or a little bit less, but the key is just to make sure you make money from the big trends, not to sit on the sidelines trying to predict when's the bubble and you make zero money, like literally $0 sitting on the sideline, waiting to, be right that the bubble was going to burst. There is no, lottery ticket for being the one that predicts the exact top.
And Beth said it earlier again, and we keep hearing this from different guests that we've had on, which it's kind of from a investor standpoint, it seems like we're only in the third inning, they say, and this is just the beginning. It just kind of feels like we've been talking about this for so long that it's almost gives me that feeling of, oh, you missed it, but not at all.
So. No, not at all. So still very early on. I think she was right. We're going to move from this just build out phase to the monetization phase, right? You got to build the infrastructure before you can start generating a ton of revenue from it. I think that will look more rational and more normal when it arrives.
Yeah. All right. Big three.
The big three. ChatGPT yesterday, speaking of birthdays, turned 3 years old. I mean, I feel like we've been talking about ChatGPT for a decade.
Yeah.
It's crazy to think it's only 3 years in, but I don't know that many people know this context-wise. ChatGPT went from 0 to 1 million users in 5 days. 5 days. That took Instagram, I think, 2.5 months. It took Netflix 2.5 years almost to go to 1 million users. Then it went to 100 million users in 2 months.
Yeah.
So it's insane growth. And now they're at 800 million users, weekly average users. So by the end of the year, it's going to be pretty darn close to 1 billion. This is definitely the fastest tech scale up that we've ever witnessed in the history of technology.
Mm-hmm. And there's just so many of them now. I mean, ChatGPT is obviously just one. It's just, and daily, it just seems like they, one pulls ahead in this, or one is proven that it's more accurate, and it just keeps, news just pops every moment.
And that drives home your point that we're still in the early innings of this, right? You shouldn't have leadership changes weekly between Gemini 3 and Grok and ChatGPT and Anthropic's Claude and whoever comes up with the next model, right?
Yep.
DeepSeek was a total deep fake. I don't think that is legit whatsoever. But the point here is that folks, here's a completely unscientific way. Just pick 10 people at random and call them and ask how often they use any AI system, right? And I bet you 7, 8 out of 10 are going to say not much at all, if at all. So we're still way early on in adoption in Main Street Americas, right? I mean, I know it sounds crazy, but 800 million users. I mean, when people were saying that Facebook was at 800 million and topped out, I mean, they've gone on to now, I think they're at 3 billion, north of 3 billion. So,
well, just a case study of one. I mean, just like we talk. I mean, I don't know, but I think but for me, I only use a couple, and I know that there's so many more out there. It's just that it's just going to take time, and more people are going to do the same thing. Once you start understanding what they do, and they're more educated on them, and they're more, ingrained in things that you use daily, and you're using it and you don't even know you're using it. That's when, people are going to be using it a lot more.
I think that's the right analogy. I always try to say it's like 5G. Remember when we went through that whole 5G upgrade to the networks, which really allowed, all right, never mind. Darth struck. Dang, I got lucky. Bought 1,000 shares of Credo this morning after hearing about it from you guys. Wow. All right. Way to go. We brought it up. I think it might have been one of our guests. I think it might have been Shai or Dan Newman that brought up Credo. I know Beth brought it up, but nice after hours move here.
Oh.
Wish we owned more. I don't own any, actually. Credo is not a name on my
Wished I
list.
owned some.
Yeah. Which brings up a point. You know what? You shouldn't have regret on stocks you don't own that make huge moves. It's never too late, like we said before, if it's a true growth trend. But at the same time, there's over 3,000 stocks. You're going to miss the wide majority of the ones that rally. You just need a few really big winners to make a difference in your portfolio.
Yeah.
Speaking of differences in your portfolio,
Supply side.
yeah, you have no idea what this is going to. The big banks are out saber rattling, saying oil is going way lower. I think today it was at about $59 a barrel. Goldman Sachs says we're going to 40. JP Morgan says we're going to 30. Funny thing is, in 2022, Goldman Sachs said it was going to 140, and that didn't happen. So I am very weary about trusting the big banks and their oil predictions. The latest ones coming out of these bulge bracket firms are based upon how much is traded in futures market, not based on actual demand. So if you look at various metrics, oil is just darn cheap, way too cheap. If you look at it based upon the oil to gold ratio, if you look at it just historically on inflation adjusted basis, and then the latest chart here is looking at money supply. When the money supply increases like it has been, oil should be going much higher. It's just historically cheap and undervalued at current prices. So this is not a market that fixes itself overnight. Remember, we had Rick Rule on, famous commodities guy that says he loves to invest in things when they're hated, and oil's finally hated right now. But you got to be patient. I think in the next 6 months, we'll be on here talking about oil much higher from here. These squiggly lines are demonstrating exactly what I was saying before. Prices adjusted for money supply have essentially never been cheaper, except for extreme market shocks, COVID, and the great financial crisis being the main ones.
It's crazy how low it is. Is it? Do you think is it supply glut, or is it the weakened economy, or tariff talks and trade wars and all that, or is it really?
No, the narrative is it's a supply glut, but the supplies really haven't been building, and it's this false belief that OPEC countries can just turn on the spigot and have a ton more ready and available to supply the market if we need. And the reality is that's not true. All these shale plays and these reservoirs are declining by 5 to 6% a year. A couple episodes ago, you remember we showed what would happen if we just stopped new production in the United States and throughout the world, and you just see a natural decline at the same time when, there were silly calls for peak oil from some of the leading world agencies that said 2030 was going to be the year that peak, oil demand peaked. And now they're revising it out that it's 2040, 2050. Newsflash, there's no peak oil, right? It's the best way to pull people out of poverty is to give them access to abundant energy, and the most reliable, most abundant energy source we have is fossil fuels. So not saying we're anti-renewables, we're just anti fossil fuel people, right? So that's
we're
anti. Yeah, two negatives equal a positive, so we're pro fossil fuels.
All right, Abusa again. I hope we have our video. Do we have our video? We gotta have it.
I think we got the soundbite in there somewhere. Goldman Sachs, I think, is it Goldman? Yeah, they're out saying stocks are not going to return much for the next decade. I feel like they bring out this battle cry once every 18 months or so, saying that you really need to look outside the U.S. if you want to have above average returns. They said that along, the last 2 years, we've had 20% plus growth in the S&P 500. They love emerging markets now. And then this next chart shows, anything but the USA looks attractive based on some of these key fundamental economic measures. But here's the thing. It's mixing the good with the bad. A lot of third world developing countries are fraught with risk. And if you think we're going to go out and pick, the one that can avoid all that and make outsized gains, I don't have an edge there. And I'm going to be the first to tell you, it's not an anything but. It's not a Nvidia or Google. It's not the USA or some emerging market. You should be doing both. You should own US stocks and then through an ETF, own an emerging markets ETF that gives you exposure to these companies that are super cheap, that have some problems. Chad, concerning, I keep adding to my number one position in prop. Keep up the great work. Look, we can share more when we can publicly, but we're committed to growing the company both organically and through acquisitions. We've got our oil production hedged out this year at about $67 a barrel. Looking forward to ramping up production. agree that this floor seems to be put in about the 180 level. So had some more recent insider buying from one of our biggest shareholders, Greg O'Neill, who is a 10% owner and one of the early founders. So again, all positive things in a tough tape for oil and oil companies in particular. But thank you for your continued loyal support, Chad. As an insider and an owner myself, I'm invested for the long term and optimistic about it. So that's as much as I can say on that right now.
All right. AI buys. Last one.
AI buys rounding out the list. And I've totally, I almost forgot it. I almost forgot it.
I wasn't going to save it because I forgot too.
Everyone's just been waiting for the consumer to stop spending. I mean, if we think for the last 2 years, credit card debt is up high, delinquencies are going up, the consumer's overstretched because wages haven't been growing. And yet, time and time again, even if consumer sentiment plummets, consumer spending, personal consumption goes up. And the latest example, none other than spending on Black Friday, AI helping drive people to buy, right? It optimizes decisions. You didn't know you wanted to buy something until AI reminded you did, but I don't even think it's really AI. Honestly, I think there's just pent up demand. The consumer is much stronger and more resilient than anyone gives them credit for. And wages have been increasing enough to keep up with debt. The stat that jumped out to me is 95.5% of all types of debt are current right now. So payments are current on everything but 4.5% of all types of loans. Now, if you go back to the financial crisis, you saw that go down, that 95% go down to like 86 or 87%. So we're nowhere near the fear levels that people are making it out to be, that the consumer is going to fall out of bed.
You're saying they're buying, but they're paying it off. They're not holding
Yeah,
on.
look, I'm not saying as an absolute level, as absolute dollar amount, credit card debt has hit, records, but in terms of percentage of income, it's not at record territory. And in terms of, balance sheet strength, there's 20 trillion in assets, household assets, and I think 10 trillion in liabilities. So we're in a much better space than people think. Darstruck here trying to get me to test my eyesight. I think having the Mag 7 together is a great strategy to ride up the averages and keep battling each other. Lots of good opportunities in emerging markets, any emerging market ETFs you like. Look, I think you just play the largest ETFs in emerging markets. It's going to be the MSCI iShares emerging market ETF. That's the best way to go about it. There's not going to be much difference between the other emerging markets ETFs. So if you have a 401k plan, whatever one is available there to you, take it. They're all going to be passively managed to mirror the index in a low expense ratio. When stocks are trading at 9 times, 10 times earnings, they're going to make moves of 20, 30, 40%. So the expenses are not going to make a huge difference if that's the decision between one that's a little more expensive than another in terms of the ETF.
All right.
All right, my friend. Well, that rounds
wraps it.
out another episode, 32 in the can. Next week, 33. We got some surprises coming. So much of a surprise. I don't even know what it is because we're gonna few guests. Nope, we got a few guests waiting to confirm, but we are looking forward to it. We got a Fed decision next week where I think it's all but a foregone conclusion. We're gonna get lower interest rates one more time, but we'll be back here. Same time, same platforms, the Big Skinny Monday live streaming 5 p.m. Eastern with the Dodman, myself, and the whole crew. So please tune in, subscribe to us on YouTube so you don't miss another episode, or follow us on X so you don't miss another episode. That's a wrap. See you next week.
See you, Lou.